This is Andrew Stotz of Stotz Investment Research looking at India Equity FVMR Snapshot. Remember, FVMR stands for Fundamentals, Valuation, Momentum, and Risk. Let's get started with fundamentals. And what we can see is that India's ROE is at a premium to the world. Nice work. And we can see the dividend payout ratio is lower than the world. That makes sense for two reasons. The first reason is if you're a developing market, you've got a lot of investment opportunities, so it's better to not pay out as much and use that money to fund your growth. And the second reason is because if you have a high ROE, such as 15-16% in this case, why not keep investing that money at that high ROE? Now, what we can see next is that the PE of the Indian market is about, let's say, 15 to 18 times, and price to book, a little bit expensive compared to the market, but overall compared to the world. But what we can see is that earnings growth, man, look at that momentum in earnings, much higher in both the current year and analyst expectations for the next year. We can also see that all of that's being rewarded. Share price over the past year has been doing very well relative to the rest of the world. And the company's got a little bit more gearing than the rest of the world. But that kind of makes sense, right? Because if you can borrow as much as you can when you are highly profitable, also we can see that ROE 15% is probably also high because the amount of gearing is a little bit high. We could look at ROA to try to see what the difference is there. The volatility of the Indian market is about 12 versus the global at about 9. It's not a perfect comparison because global's got every company in the world, but we can use it to look across the country. Now, let's take a look at some areas. We can see that consumer staples got very, very high ROE. And the lowest ROE that we can find here is in the utilities, which is kind of normal. That means that the utilities companies are not gouging customers. And if we go from there and we look at the PE, we can see that the expensive sector, well, high ROE gives you also a high PE and a very high price to book. So consumer staples looks awfully expensive, but EPS looks pretty steady. So now let's look at some of the other sectors. We can see telecoms. Whoa, that is an expensive sector, but that's on an earnings basis, and that's probably because we can see a fallout in earnings here and a recovery in earnings there. If we look at price to book, it's not bad, about 2 times price to book. However, the problem that the telecoms sector is facing is ROE is disastrous. And recently, of course, there's been a new entrant that's been slashing prices, so that's hitting it, and we can see that hitting right here in the actual prices. Where is there a recovery in EPS? Well, we can see pretty good recovery right there in the materials sector and consumer discretionary. And we can see that that materials sector in particular is up 50%, and consumer discretion is up about 24%. Now, finally, let's take a look at the volatility of the sectors. And what we can see is that the lowest volatility sector is consumer staples, followed by healthcare. And what we can see about that is the highest volatility is right here, consumer discretionary, along with the telecoms. That gives you a general picture of what's happening in India. Relatively high return on equity, though that may be partially because gearing's a bit high. You're paying a slightly higher than world average PE and price to book also, but you're getting steady earnings growth. Right now, analysts are forecasting between about 17 to 18% earnings. So not a bad story in India right now. If you want to see the FVMR snapshot for your country, just let me know in the comments below. Have a great day.